Feeling?
Feeling good, Isabella.
So you've been advocating, I guess, for the City of London and the UK over in the US the last 2 days.
Yeah.
How were you received, do you think?
Look, well, I think the people understand that the UK is resilient. You know, we're all dealing with some of the same challenges. You've just had a panel about how can we get more growth, but within the overall pack of G7 economies, and particularly the European G7, you know, the UK's towards the top end of that in terms of where it is right now. And look, it's always a bit of a surprise, and we'll probably go down into the weeds of listings and all those other bits and pieces that, you know, we all, you know, the right things to focus on. It's a big part of my day job. But when you step back and look at the UK with its established rule of law, English language, fortuitous time zone, second biggest and most international capital market on the planet, people do see the UK as highly investable, right? So there are all sorts of bits of the financial markets globally that, because of the change in interest rates that have come along quickly and some of the geopolitics that a lot of people are, you know, just trying to process and work through, there are bits that are, you know, like on listings generally in the UK, in the US as much as in the UK, that's a little bit fallow at the moment, and we've got an ambitious program of reform over here. And then the other thing is, you know, with that distance, of course, the ambitious reform program that we're, I would say, about halfway through, the act that we passed last year, of course that's not fully understood, just as we wouldn't necessarily understand, you know, what the latest minutiae from the SEC is. You know, when they look further afield, they definitely see us as a very, very investable place to put capital to work, but they don't also know some of the changes that we're trying to drive through. So that is why I was in Riyadh a couple of weeks ago with the Deputy Prime Minister, Dubai, and then New York, is, you know, together with many, many others, the Lord Mayor does a great job, lots of independent institutions themselves, it is quite right that we go and tell our story in our own words.
And do you think then the message is coming through? Will we, you know, how do you hope to woo more international companies to come to the UK?
Well, look, I think they do anyway. So it's not that, you know, we're going off and doing one little bit of wooing and that's going to secure the future of our capital markets. Much more so, and remember, you know, primarily we are legislators, much more so is to get all of the ingredients right, build on those really strong foundations that we tend to overlook because they're right under our nose. But, you know, it's not every market in the world that has that institutional stability that's seen us through the last few years, which have obviously, you know, we've all had to deal with the geopolitical and the challenges of COVID. But there's never been a day that markets haven't functioned, and that you can't say that about everywhere in the world. The things that make London, in so many ways, London and the United Kingdom attractive, the ferocious talent of people here, whether it's talent in the City of London, one of our great assets, you know, 13% of our overall economy is in financial and professional services, but also in our universities, the innovators, the founders, in all of those growth areas. You hear a lot about that from the Prime Minister and the Chancellor, about how we've got all of those advantages. My own role within that, in my swim lane, is how do we have a series of financial services reforms that move the dial, that do allow more productive capital to put to work. That is a key theme of what the Chancellor and I are doing at the moment, trying to put a new duty on the regulators. This is a big change, and I think you will see compounding results over time, that duty to promote the economic growth of the United Kingdom and our international competitiveness. We followed up that duty in the bill. We'll be publishing a scorecard for the regulators to follow. And so as much as, you know, you might make selective and quite discerning and thoughtful changes to the actual corpus of regulation. You know, solvency is one good fact pattern because we've used a slightly different approach to that to others, but in a thoughtful way. But alongside that, there's an awful lot about the actual conduct, in many ways the clock speed of regulation. You know, the way a big US institution will often interact with the UK regulatory system is they'll send a brilliant executive to London, and someone had been doing the same job, often running the same money with the same level of responsibility. And of course they have to go all the way down to the sort of bottom of the snake and climb the ladder again in terms of getting authorised in the UK. And if that's 6 weeks, no great shakes. But if that's 6 months, that starts to become a point of friction on the effective operation of markets. And that's a good example of what I mean by improving the conduct of regulation.
So what are your priorities now moving on, like in terms of, cutting red tape more? How can we mobilize capital in the country further?
I think there's at least two things. There's a lot of work on what I call, in not a diminishing way, but the plumbing. How do you get prospectuses that are a little bit more fit for purpose? Some of them are 140 pages long. The only person that reads them is the General Counsel that produces them. So they're not really doing their job. How do you abstract paper from the securities system? We still have paper share certificates. We're kind of...
But they're so pretty.
They're lovely, and we'll make sure you get some lovely mounted prints. But if what that means is that you have to keep your offer open in the UK for 21 days because it was built for an analogue process in which someone had to go down and post their application form, that's not fit for purpose today. So there's a bit on just how do you steadily, in almost every domain, just tune it up and make it a little bit more fit for purpose. Always within, I'll say this because I say this all the time, always within the overall envelope of being a high quality regulated environment. This is not a tear, it's not a race for any bottoms. We are members of the FSB, the Bank of International Settlement, IOSCO. We're always going to be in that top tier and use our voice for top quality regulation. But it doesn't mean you can't try and do the same outcomes in a quicker and better way. That's point one. Sorry, I'll only give you the second. The second point is, how do we mobilise more productive capital? And that is a little bit, again, about changing the dial on the appetite for risk and all of the little nudges in the regulatory system that militate against risk-taking. A really good example is the work that the Chancellor, myself, the Minister for Pensions, the excellent Minister for Pensions has done on pensions. If you're as young as most of this audience, you don't want to pay a liquidity penalty. You don't want to have worse performance, have a lower pension in retirement, because all of the thrust of a regulatory system is to say that everything in your pension must be daily liquid. You must be able to sell it all instantly. If the real world experience is you actually want those assets to grow and fructify for the next 25, 30 years, there's got to be a little bit more of a better balance. That's why we came forward with the Mansion House reforms. It's why we've worked on a voluntary basis with the industry to say a certain percentage, quite a small percentage, of your pension fund money should be in illiquid assets, energy, infrastructure, all of these exciting growth companies, all of these areas that are actually going to see outsized growth compared with putting it into short-term or fixed income securities.
Speaking of pension reform, everyone was expecting the King's speech to lay out the groundwork for the government, but there was no mention of it. Why is that?
Well, there's a huge amount we can... legislation is long and slow. I mean, even the quick version of legislation is a long time. Things get amended. So to me, I'm very, very comfortable and happy with a world where we get on and do everything that we can within the existing legislative environment. People talk about the de-equitisation of pensions. This was a very literate room, but so you'll understand what that means. All of that's really happened under existing legislation. It wasn't a law that said pension funds had to own less equities and less risky assets. It was much more in the individual codes. So we have a federated system. The law gives regulators the power, but then the regulators shade in all of the fine detail. And it's the fine detail where those little nudges are, and we can change that, working with the regulators, working with the industry.
I mean, it's quite interesting that you have these sort of conflicting approaches in some ways. On one hand, you want to reduce frictions and make everything frictionless. And certainly we saw earlier this year that there are downsides to that. If you look at, say, the bank runs we saw, frictionless technology played a role in that. On the other hand, you're kind of moving towards more, encouraging illiquid investments at a time when many other countries in Europe are trying to encourage people to invest in their bonds. So is there a conflicting message here, and is there a risk?
There is. Look, you illustrate the sort of two extremities well, and that's absolutely intellectually right. The truth is these things are always a balance. And as I have learned, partly as a practitioner, but mostly in this role for the last 12 months, the law of unintended consequences runs large in financial services regulation. You'll take an action, post 2008, to try and eliminate one particular risk, and then you'll squeeze the balloon and risk will pop up somewhere else. We saw that a bit with LDI. If you don't invest pension assets in growth asset classes, they won't necessarily outpace inflation. So you will get steadily and quietly poorer. You think you're managing one risk over here of volatility, but actually you're taking another risk on the other side. So it is, I'm going to be annoying about this because every time I speak, it is about a balance. And I'm pretty moderate about these things. We've got to articulate that balance as a proper job for society and for regulators to say, where do you want that? But what I don't think you should do is have a financial system that is set up to extinguish risk. Both because it won't be able to do that anyway, but also that's not really a desirable end in itself. Mitigate, yes. Minimise, yes. Surface the risk so it can be knowingly accepted, but not to actually sort of believe that you can eliminate that.
And what's your plan then for ISAs? Because I believe that's part of the agenda too.
Well, watch this space a little bit. It would be wrong to comment on any particular proposal, but the Chancellor did say we would look at what is the third leg of capital. So we've talked quite a lot about the supply side, the plumbing, how do you make sure markets work, how do you get lots of listings? That's the supply side. On the demand side, you've got three really big pools of capital. Massive amounts of institutional capital in insurance companies. We don't often see that because that's where all our premiums go or our annuities sit for many, many years. And we tried to mobilise some of that capital to productive uses through Solvency UK. And we've done that. That's now on the statute book. That's done. The second big pool of capital is pension fund money. All of us have got a pension fund. We're enormously fortunate in the United Kingdom. We have the second largest pension funds in the world, second only to the US. It doesn't always feel like that. And that's because our pension fund industry is quite fragmented. Right? It's not my job to pick winners or decide what an exact outcome is, but the reality is it is quite fragmented, and you'll often hear about Australians and Canadian pension schemes. Because they're much more consolidated, they're much individually bigger. And sometimes that means they can be a bit more sophisticated and they can take more risk. I don't want anyone else's pension scheme, to be clear. I want us to have the best version of ourselves, but consolidation is a theme that runs through how we think about pensions. And then the third piece of capital, demand if you like, is your ISAs and savings. And we are working on how we can better get people to access advice. I mean, it's a big piece of work anyway in society about financial literacy. Lots of fantastic work that's being done in that space, including how do you actually communicate numbers and concepts more clearly. As you all know, the Prime Minister is very, very keen on numeracy anyway, and that helps that agenda. And ISAs are wonderful things. ISAs are one of the few. The state isn't very good at creating, new financial architecture. But in this particular case, the state has created something that, is decades old, highly popular. I think over 40% of people in the UK have some sort of ISA. Quite a lot of them are in cash ISAs, savings. And if we can work on things like the availability of financial advice, whether that's because you've got new AI coming. Everyone loves talking about AI, don't they? So if it could be more, you've got robo advice and using digital tools, but it could also be that we make it cheaper and easier to access the sort of financial advice that used to exist. And then because of some of the mis-selling that happened in the past, that needed to be tightened up. But it's meant that very few people can afford to have good access to advice. So looking at ISAs, looking at what we can do to democratise again financial advice. And it would be a better world if more people obviously had the financial wherewithal, but were then able to invest.
So would you like the UK to become more of a meme stock society? That is like the radical end of democratisation of investing and equity kind of hysteria.
I'll go almost all the way there, Isabella, which is, and we're never going to, we're English and British, right? We're never actually going to talk to the same degree as Americans. But if you go to a barbecue in America, people will talk about, their soccer game, it's still called football, or they'll talk about, sports, but they may well also talk about, what's in their 401k. And they definitely feel they've got more agency about planning for their own future retirement. We've got a good pension system, but very, very few people, and I've been testing, I won't test you, but very, very few people actually know what's in their pension. Right? No one's got any agency. It's highly disintermediated. You don't really know what policies the fund manager's following. And that does.
Do you know what's in your pension?
Not that well, no. I'm not allowed to.
Yeah,
I'm a minister. You're not allowed to know what's in your pension in case you've got a conflict of interest. There you go. That's
Fair
my
enough.
get out of jail free. But the more pertinent question is, the day before I was a minister, did I know? And the truth is, no, I didn't know either. And that's not a bad thing. So you don't want to go all the way to meme stocks, but it wouldn't be a worse society if we had more knowledge of, the great, often British, not exclusively, but the great British companies that are out there to invest in.
So I want to squeeze in two last questions. Very quickly, how worried should taxpayers be right now about central bank losses at the Bank of England?
Well, and Andrew Bailey, the governor of the Bank of England, whose job that is at pains to talk about the security and safety of the financial system. We've come through, lots of bumps in the road. We're dealing with, very significantly higher cost of money than, as is every Western economy. So I don't think, of all the things we should worry about, and there's lots of things in the world to worry about, I don't think we should worry too much about that.
But if there's going to be, I think the projections are 150 billion in, losses over the next 10 years, which have to be indemnified by the Treasury. If that comes at the cost of NHS funding and other public services, people will start to care about that, no?
And we should all care, and we do care about the cost of money. And one of the jobs of government is, you've got to control what you can control. So we have independent monetary policy. So the actual setting of interest rates sits out with our swim lane. But there's an awful lot that the government can do, and that's why, the Prime Minister, the Chancellor, others in the Treasury have been at pains to say we are going to take those tough, difficult choices to make sure that we run the public finances prudently. Because if we don't, that's when you would see that cost change or escalate.
In terms of options for funding that cost, are bank windfall taxes on the cards?
Well, we already have really significant additional taxes on banks. So banks pay full freight on their corporation tax. Because of the nature of their business, they're not necessarily buying machines. They're not always able to take advantage of the same sort of capital allowances and deductions as others. So they're already paying full freight. On top of that, there's a surcharge. On top of that, there's a bank levy on their balance sheets. And then we put lots of social purposes on banks as well. So they are funding, branches where we impose on them a duty to promote the access of cash. They're often bailing out consumers for fraud in the system to the tune of, definitely 500. I think it was nearly $1 billion when you added in the cost of all the compensation schemes. So I understand why people ask that question, but believe me, we are all vested in the success of the UK's financial services industry, right? It's not a perfect analogy, but it's a little bit like, Germany in the automotive industry. If you don't get some of these big core industries that your country is prodigiously good at right, you're not going to grow the economy, you're not going to drive the prosperity we need, we're not going to have high quality public services, and we're just going to get ourselves into a spiral of just, taxing every form of private enterprise more, in the hope that you can just run an economy on that basis. Now, that is not my view. That's not the view of the party I'm part of. People get choices, right? That's why we have elections, but I'm pretty clear where my view is.
We're in the red. I didn't even get to ask you about crypto.
1 second in the red.
Crypto regulation, or I was planning to ask you if you own some Bitcoin, but sadly didn't get the chance. So
I do not own any Bitcoin. There you go, Isabella. Revelation.
That's been established now.
But we are progressive when we think about innovation. So we'll always be balanced. We're not at the extremity, but it is right that as you see innovation happen, some which will be violently successful, some which won't, it is right as legislators that we embrace some of that. That's why the King's Speech, although it didn't have a pensions bill, does have a bill on level 4 autonomous driving, because as a country, we can be successful if we carve out niches for ourselves in these new domains.
Well, thank you very much. That's been a fascinating chat. I'm here now to tell you that there is a networking break, so please do make your way to the coffee stations, and we will be back here for the next panel discussion at 3:45 p.m. Thank you very much. Thank you, Andrew.
Thank you. Thank you.